Shouldn't be. Hello, everyone. I'm Pearl Jean Maeve, and I would like to welcome everyone to today's webinar. Webinars are brought to you as a membership benefit of Heritage Ohio. Heritage Ohio's mission is to help people save the places that matter, build community, live better. Today, we'll have a presentation on understanding opportunity zones. We'll be taking questions at the end of the presentation. If you have a question, please type it into the question box at any time. Most issues with the webinar software will be solved if you close the program and restart it with the link that was sent to you. Our presenter today is Dan Berggren. Dan is a tax attorney with GBX Group. He has significant experience in real estate and tax credit financing. He works directly with GBX investors and developer partners to structure and execute a variety of real estate and tax credit investments. All the really fun stuff. I also want to just add really quick that there is a handout with the slides. So if you would like to download the slides at this time for your personal note taking, you can go ahead and do that in the thing, the webinar thing. Sorry, the control panel. Thanks, Frank. And with that, I will hand this over to Dan. Dan, take it away.
Thank you, Pearl. I'm going to do a couple of quick apologies up front. Thanks for everybody for joining. I'm going to apologize in advance, both for being a tax lawyer, and hopefully it won't be too boring. And then second, for this cough that I can't seem to kick from whatever summer cold my kids gave me. So if I go mute for a second, it's that I don't want to subject you all to that. But thanks again for joining, and thank you to Heritage Ohio for letting me introduce both GBX Group and opportunity zones, which is something that we're pretty excited about. I want to start out by just giving a brief introduction of GBX Group. GBX Group is formed to acquire and preserve historic real estate, and we do that through a variety of different federal and state tax incentives. We will typically identify properties both in Ohio and throughout the country that fit the profile that we're looking for. So if you have properties that you think make sense to talk to us about, my contact information is at the end of this webinar. Typically, we are only looking at historic properties, and one of the reasons why we partner so well with Heritage Ohio is because we're both focused on that. To give you an idea as to what government promoted tax programs we can use to help fund either your investment in real estate, your investment in preserving real estate, or in developing real estate on your own or representing clients that do so. We use a variety of different federal programs, including historic preservation easements, which place a permanent restriction on the facade and the development around any historic building. Federal rehabilitation historic tax credits, which the state of Ohio is extremely competent in the use of and has quite a bit of projects throughout the state that have utilized both federal and state historic tax credits. Just now, we're going to talk about opportunity zone investments later today, but that is something that we are actively engaged in. And then essentially any other federal, state, and local incentive programs to help finance your real estate project. To give you an idea as to what we mean with that, typically when you're financing real estate, you'll see a traditional 2/3, 1/3 equity debt structure. With GBX Group, our aim is essentially to squish down that debt and the actual investor equity down as much as possible with these federal tax incentives. We'll also show state and other incentives in there. And that's really what GBX provides to a developer and to real estate investors. Obviously, it's always nice when we can use incentives to cover 100% of the cost of financing. That's obviously not that common. And then to give you an idea as to how often we've done this, GBX Group has over 700 investors, has completed projects in 14 US states, with I know at least another 4 or 5 coming this year, and well over 100 completed projects. So with that, we'll turn to opportunity zones. The Opportunity Zone program, which came into being at the end of 2017 with the Tax Cuts and Jobs Act, was aimed at unlocking an estimated $6.1 trillion in unrealized capital gains that US investors hold. The program was created essentially to drive some of that unrealized capital gain into low-income communities through private investments. And so this incentive is designed to encourage investors, and you'll find later that really that is a very wide group, into realizing some of those capital gains, but through this program, deferring and getting some forgiveness by investing it into qualified low-income communities. As a result, 2 new sections of the Internal Revenue Code were created. And if you are of the mind to go and read them, those are the statute numbers. So essentially, the state of Ohio and each different state across the country at the beginning of the year was told by the federal government, you need to go and tell us which census tracts you want to qualify. They had to be low-income census tracts as determined by the same standards as new market tax credits, which means that over half of the residents living in that area are below the average median income for the United States. But one important thing to keep in mind is that the census data that it was being used in order to come up with those census tracts is from 2010 with some very little updates. So you'll see that some of the zones that were designated are maybe not in areas that you would consider to be distressed, but are maybe areas that are now seeing some recent redevelopment and may provide good opportunities for investments that are not necessarily aimed at being in low-income communities. So at the beginning of the year, the Ohio Development Services Agency sent out a request for different census tracts, and they led the effort for the state of Ohio to help nominate different census tracts that could be then certified by the Department of Treasury. Each state was limited to only submitting 25% of their low-income census tracts. So for the state of Ohio, as of the last census, we had 1,280 low-income census tracts. Ohio submitted 320 of those, and all of them were since certified. Through the nomination process and through discussions with ODSA, we were very fortunate to see a good mix between both urban and rural areas. So there's really a lot of opportunity across the state, and there will be obviously some issues as I go through this presentation with using the word opportunity over and over again, but it's kind of hard not to with this program. But you can see there where the different zones are across the state of Ohio, and to see if whatever project you're working on is located in one of Ohio's designated zones. I've gone ahead and put in the web address for ODSA's website to determine what census tracts qualified and what didn't. If you're looking at projects outside of the state of Ohio, or if you have investors in Ohio that are looking outside the state, there is a website that is put through by CDFI, the Community Development Fund, and that is www.cdfifund.gov. And they'll have a map there that you can use to look at census tracts that were certified across the United States. So let's get into a little bit of the tax benefits of investing and why someone would invest in a project in an opportunity zone. The main three options here are the deferral of capital gains. There's an aspect of forgiveness of some of that capital gains. And then the piece that gets people excited is that at a certain point, additional capital appreciation is tax-free, almost like a Roth IRA where you're putting money in after tax, but you're taking it out tax-free. So let's unpack that a little bit. The capital gains that can be deferred are really the sale of any property. And this is where we really differ from things like 1031 exchanges or small business stock exemptions. You can literally sell any property. And it has to be capital property, but that means it can be stock that you own in IBM. It could be a business that you sold. It could obviously also be real estate. But you have all those different options. So the mechanics for this are fairly straightforward. You receive that capital gain, and within 180 days from the date of the sale that created that gain, from when you sold the stock or when you sold your business or when you closed on the sale of a piece of property, you have 180 days to invest in an opportunity zone fund. And if you do that, the amount that you invest will be deferred. Now, this is an important distinction to draw from 1031s. In a 1031 exchange, you have to invest all of your proceeds from the sale of a piece of property. And any proceed that you take off the table will be considered capital gains. In the opportunity zone benefit, all you have to invest is the amount of gain that you want to defer. You can take your principal off the table, and that's a really important distinction. As far as the deferral lasts until you sell your investment or until the end of December 2026. You may be familiar with the fact that a lot of the Tax Cuts and Jobs Act's personal and individual benefits sunset at the end of 2026 in order to pay for some of the larger tax changes that came through in that law. So this is one of those things that in order to even out the side of that balance sheet there, that they need to end the deferral at the end of 2026. The second aspect here is the amount of forgiveness of that capital gain that you get. Now, when you invest that gain into an opportunity zone fund, 5 years after you make the investment, the amount of gain that you have to recognize in 2026 is reduced by 10%. After another 2 years, you get an additional 5%. So then the remaining 85% of your old gain is recognized on December 31st, 2026. Now, the important thing to keep in mind, and we'll touch back on this, is that after 2026, once you've recognized that remaining old gain, any additional capital appreciation is tax-free if you hold for 10 years. You could sell it at any multiple you want to make up, but at the end of that 10 years, anything you sell, any gain you make in addition to that old gain is 100% tax-free. So to illustrate that, we put up a timeline here for you with an example investment of $1 million. Assuming you invest that old $1 million gain into your Opportunity Zone Fund in 2018, you get to defer your tax. Now, after 5 years in 2023, 10% of that old gain is forgiven. And now you're down to $900,000. 2 more years pass by, and in 2025, another 5% of the old gain is forgiven, and you're reduced down to $850,000. Now, as I just said, we've got to recognize that remaining $850,000 at the end of 2026. But at the end of 2028, after 10 years, any gain in excess of the initial $1 million that you put in is 100% tax-free. So one of the things that we're looking at very closely is how this plays also on estate tax impact. If your taxpayer's home state conforms with federal laws, which Ohio does right now, the deferral of the gain on your federal tax return would also act as a deferral on your state income taxes. And that will help boost some of the gain that you get from this, some of the yield that you get out of this. So let's talk a little bit about the funds themselves. You know, what are they? What can they invest in? How do I make one? That sort of thing. Now, any type of entity can be a fund. It could be a corporation, a partnership, an LLC. I would suggest, typically that you create some entity in order to use that as an investment vehicle. And the requirements are that it is organized for the purpose of investing into this qualified opportunity zone property. And that's a pretty wide open definition. There's a lot of flexibility with this right now. And that really ties into the last piece of this, which is that the IRS has told us that these funds are going to be self-certified. So you can potentially wait for a little while to create one. You can create your fund with any group you want. There's no requirement that it be a community development organization. There's no requirement that it be a nonprofit. These are very wide open, and the IRS has been told by this administration to keep it loose, keep it wide open, and encourage investment. So once you form your fund, you have options into what you can invest in. You can invest into stock, partnership interests, or business property, all of which have to be qualified. So qualified opportunity zone stock and partnership interests is pretty straightforward. Your fund essentially will take newly issued stock or partnership interests or LLC interest taxed as partnerships in an active business that's located in an opportunity zone. That stock has to be acquired after December 31st of last year. So anytime from now on that you make this acquisition, you're going to be okay. But what they don't want you to do is go back and say, hey, my business is already located in this zone and I bought stock on it 10 years ago. That won't qualify, but there are some abilities for us to help structure transactions in a way where you do have an existing business that's located in a zone and you do want to potentially reinvest into that business, we do believe there are ways to do that. And that would be something that would be a little outside the scope of this, but certainly something we'd be happy to talk with you about. The last requirement is that substantially all of the tangible property of the business that you're invested in is qualified opportunity zone business property. So, what is that? If you invest through a corporation, partnership, or LLC, that underlying entity has to make sure that it's invested in these qualified opportunity zone business properties. Or if you create a fund, you can also directly invest right into this property. And so the property has very similar types of qualifications. It has to be acquired after the end of last year. So if you are doing projects where you are starting your development on a piece of property that you bought last year or the year before, or maybe 10 years before, you're going to need some structuring help in order to make that work for qualified opportunity zones. The other requirement is that the piece of property that you're buying or the machinery that you're using, whatever property you're investing in, has to start its first use with this fund. Or if it's real estate, the fund, once invested, has to substantially improve the property. Now that substantial improvement will follow very closely if you're familiar with historic tax credits, because the requirement is essentially that you invest as much money as you bought the property for or what your basis in the property is right now. So if you bought a piece of property last year for $1 million, if you were to do an opportunity zone investment, you would have to invest at least $1,001 into the improvement of that property to qualify. But you would also have to do that in order to qualify for historic tax credits, which also uses a substantial rehabilitation test, very similar. And then finally, the property has to be used in an opportunity zone. So you want to make sure that if you are buying a piece of heavy machinery, that its primary use is in the zone and that you're not, say, renting it out to some other party that is not within an opportunity zone. So as far as the benefits to investors, I think we've covered that pretty broadly. But why, as a developer, would you want to either do this yourself, or if your client is a developer, why would you want to encourage this type of investment in your project or your property? Well, the benefit of that deferred tax until 2026 right there gets you, if you look at a standard internal rate of return, it'll get you about 1 to 1.5% increased internal rate of return on your initial investment if you compared it to something where you didn't have that deferral. So if you're putting together projects with preferred capital returns, preferred equity, priority returns, this will potentially allow you to flatten that a little bit because your investors will already get a little bit of an extra boost from that deferral. The other piece to look at for those of you that are looking at developments where you have limited partners and you get what would be a carried interest or promote on the back end of your project, say that this typically would be a developer that would come in with sweat equity and raise capital from third-party investors, and once their capital gets returned to them, there would be something called a promote on the back where you would split anything over and above what they had put in the project. This may be a lot, the normal split for that is 80-20, and what that means is that anything above what your investors put in the project, they would get 80% of, and you, the developer, would get sweat equity of 20%. Allowing for an opportunity zone investment means that if you increase the value of your project substantially, because a substantial part of that on the back end will be tax-free after 10 years, your ability to change that carried interest percentage may be dramatic. You know, maybe it shifts to, instead of 80-20, 50-50. You know, obviously you'll have to do the numbers to look and see, but because the investor isn't going to pay any tax on the gain over and above what they've already put into the project, the potential, you know, returns for them are substantially higher, which allow you to maybe boost your own returns. So the other thing is that if you put in opportunity zone money, it has to come in as equity, and it can't come in as debt. You can structure it to be somewhat similar to debt, but it can't come in as debt, which may allow you a lot more flexibility with your capital stack. If you need to layer in other mortgage holding debts, this would potentially not have a mortgage because it wouldn't be set up as debt. So, you know, you can use a little bit more flexibility with the way you put together your capital stack. And if you have specific questions on that, you know, please ask them in the webinar question box, or, you know, feel free to contact us. So lastly, we want to talk about opportunity zone funds and historic properties. There's been a lot of discussion about pairing opportunity zone funds with different types of federal and state tax credits, both historic, new market, low-income housing. For the purpose of this webinar, we're going to leave it at historic. But I want to let you know that opportunity zone funds can be used along with federal and state historic tax credits, and it's relatively straightforward. The chart in front of you shows a fairly simple historic tax credit investment where you would have a direct investment or a single tier investment. And what that means is that your historic tax credit investor would invest directly into the property owning entity, and then they would end up taking a 98 or 99% interest in that property owning entity, which would allow them to take the corresponding percentage in federal historic tax credits. Now, that investor would have to take their equity from their capital gains and take it from here, and they would invest it first as equity into an opportunity zone fund, and then that equity could be invested down into that project LLC directly. Depending on how you structure, you would potentially also have a state investor member come in either separately into the project LLC or along with the opportunity zone fund and the federal investor. Slightly more complicated is the pass-through or lease structure for historic tax credit investment. We would still have equity being invested from your opportunity zone fund directly into the master tenant LLC, which would then have a lease from the master landlord or the property owning LLC, which would allow the pass-through of federal historic tax credits by statute to that tenant. It's important to take a very close look at how you're structuring if you're looking at doing historic tax credits with an opportunity zone fund. Along with the Tax Cuts and Jobs Act at the end of 2017, there was a change to the federal historic tax credit. And if you're familiar, the federal historic tax credit is a 20% credit, and that 20% is related to your qualified expenses. And typically what was happening prior to the end of 2017 is that when you would complete your project, you would so-called be placed in service, you would get 20% of your qualified expenses as a tax credit in the year that you placed in service, in the year you finished your project. Now, the 2017 tax law changed that and made it so that your 20% credit is taken over 5 years, ratably, in 4% tranches. So the yields there changed a little bit. This may be a good way to help bump them up. But the reason I bring it up isn't so much for that as one of the pieces that was stuck into that tax law act is that there was a transition rule that allowed for the old 20% all in 1 year tax credit to stay in your project if you met certain transition qualifications. Primarily the fact that you owned and or leased your building prior to December 31st, 2017. Now, a lot of people are set up in a way that allows them to satisfy that requirement because they've already owned their building for a while. The way that the opportunity zone statute is written, though, is directly conflicting. If you recall from the earlier slides, you can't invest in anything that wasn't new to you after December 31st, 2017. So we do believe that there is a way to satisfy both requirements, and it really lies in this lease pass-through structure. You can own the property as a landlord, LLC in this case, and then you could put into place the master lease pass-through structure and still allow for an opportunity zone investor to come into that master tenant. But I would definitely caution you and make sure that you're seeking professional legal and tax advice when you do that. As your investors, if you've got a large enough project where you've got a third-party investor, you're going to want to make sure that they're very comfortable with how you're setting that up prior to making those changes. So wanted to make sure you are aware of that as we move into the last couple slides here and the ability to take some questions. So where are we now? It's the end of August. At the beginning of the year, we had some nominations. By April, May time, we had all of our funds certified, all of our census tracts certified by the IRS. And right now, we have very, very little guidance from Treasury, from the IRS, as to how they view this and how they think these investments can be put into play. There are a lot of people that are not doing anything until they know what the IRS has to say about that. We think that there are lots of things that you can do right now that follow the letter of the law as enacted to start setting up opportunity zone funds and take advantage as the regulations or whatever information the IRS puts out comes. According to Treasury, and this is why I've got quotes around the word soon there, they claim that they will have guidance out to us soon. 6 months ago, that was June or July. Right now, we're hearing earliest October. My guess is if we get something by October, we'll be pretty lucky. I would hope to have something before the end of the year. But what does that mean to us now? Because you have to remember, you have 180 days from the date that you sold or that your client sold whatever property it was to generate this capital gain. And for a lot of people, that means that your timeline is a lot earlier than the end of this year. Due to the fact that the law is in place and that we know that these funds are going to be self-certifying, I don't think there's any reason why you cannot set up an operating entity right now that is intending to be an opportunity zone fund that qualifies under the statute, and allow yourself the flexibility to make an election once we know what that form looks like, to defer your capital gains through an opportunity zone fund. So you could very easily right now, and speak to your legal advisor and set up an LLC, set up a corporation whose primary business is investing in qualified opportunity zone investments, be it property, stock, or partnership interests. And then give yourself the flexibility to defer your gain for now. And if you decide when the regulations come out that your project isn't going to work, just take that money out. There's nothing that says you cannot pull it back and then just pay the gain on your taxes next year. So this is a very flexible program, and I think it will stay flexible. And I just want to convey that you should not be afraid to start setting up some of these things now, especially if they're projects that you're already intending to do. And that leads into my second point, which is, what are people looking for on an opportunity zone fund investment? What is an investor looking for from you as a developer? What are you as an investor looking for, in my opinion, which obviously is biased here or there, but at the end of the day, because you're only getting a little bit of a boost from the deferral until 2026, the real showstopper, the real thing to focus on is what your 10-year outlook looks like. Because that increased return, if you can somehow sell a business, sell a piece of property for 3 or 4 times what you buy it for today, 10 years from now, then that investment looks really, really good. And it looks good not just from an opportunity zone investment standpoint, but from a regular investment standpoint. And that's the point I want to make, which is that the best investments, the ones that will drive the best investors to invest in them, are going to be projects that this is just extra, that this is extra gravy on top, that makes sense and pencil without this benefit. And now, if you have a project that really makes sense and really looks good on paper, even without this benefit, then you're really well ahead of the game on looking for investments through these opportunity zone funds. So with that, I wanted to leave enough time for at least 10, 15 minutes of question and answer. I know we covered a lot of ground, and there's quite a bit of different things that we discussed. So if there's stuff that you want to get a little bit more in depth with, please ask on the questions tab of the webinar screen.
All right, you heard the man. Ask your questions. We do have 3. Would you like me to go ahead and read those, Dan?
Sure.
All right. So from an earlier slide, from the timeline slide, Danielle asks, what does it mean that gain must be recognized? And you may have already addressed that.
That's a good question, Danielle. Thank you. A lot of what we're seeing is that people are telling investors that you can take unrealized gains. That's kind of true. What it means is that whatever you have that has a gain that's unrealized right now, so let's say you have $1 million of IBM stock that you paid $500,000 for, so you've got $500,000 of unrecognized or unrealized gain that's sitting there. In order to trigger gain that's usable to invest in an opportunity zone fund, you have to sell that property. And you recognize the gain later, but you'll sell the property and that gain will be deferred. And then in 2026, whatever hasn't been forgiven, so if you invested and you've already been in for let's see, 7 years now, and now you're hitting year 8 and it's 2026, you've got 85% of your gain that still has not been forgiven. And what it means to be recognized is that on your tax return for that year, you will have to show that 800, that the timeline example is 850,000. So that 850,000 would then go down as capital gains income on your tax return. And so that's what I mean is by recognizing it. There is a piece of the statute that modifies that a little bit. It's a little bit more nitty gritty, and essentially what that is you can also get an appraisal for the fair market value of the property as of December 31st, 2026. And if it's a lot less than what you put into the project to begin with, the amount of gain that you have to put on your tax return will be will match that appraisal and be a lot less. So hopefully that answered the question for you.
Great. So the next question, curious about the scale of projects that will benefit. Are projects under 1 million viable using opportunity zones?
That's also a good question. I think that people think that this is really a tool only for people with really, really big gains. And I don't think that it's that case. I mean, I think the fact that it's going to be self-certifying is going to allow a lot of flexibility for people with small projects to either, take some of their own money and invest it in their own projects through an opportunity zone fund. And that can be, as much gain as you want. I mean, if you sell something and you've got a new business and you sell a piece of stock to pay for the startup costs for that new business, and you have a $10,000 gain, I would tell you, hey, it would be great to put that 10,000 along with whatever else you're putting in, and now you've got at least a portion of your business potentially tax-free if you sell 10 years later. Another thing that we're seeing a lot of where the scale is a little bit smaller is people that are doing 1031 exchanges. And as I said before, when you do a 1031, you have to put all of your proceeds into a new investment, into like-kind investment. And if you take any of those proceeds off the table and put them in your pocket, it's viewed as capital gain. Now you can take that capital gain, which is referred to as boot in the tax world. You can take that capital gain and then invest it into an opportunity zone fund and defer, that piece of non-1031 gain and put it into something else. I think because there isn't a real strong certification requirement, that the size of project is going to vary widely, and it'll be as little as $50,000 or $100,000. I could see making sense because you're still deferring $20,000 of tax. I mean, I would do it, and it's not going to be a very large undertaking.
All right. So next question. If I live in a small rural community, will there be opportunity zone funds available that want to invest in my community?
That's a good question. I think there will be, but I want to really stress that your project has to make sense without this. And if you have a great project, wherever it is, if it's downtown Cleveland, or if it is, name your small town in Ohio, Lima, we were speaking with some people, if there's a project there that makes sense, that looks good on paper, and that you can back up, then yeah, I think that there's absolutely ways to drive investment there. And funds are being started for this purpose all over the country.
Okay. And then Lauren wants to know, can you do a brief walkthrough of an Ohio downtown project? Just an example.
Well, let's see. I'm trying to think of what would make sense. I guess I'm not 100% sure on what you mean, but I'll try and wing it here. So I am sitting in downtown Cleveland, and downtown Cleveland was fortunate enough to basically all be nominated and certified as an opportunity zone. And I could see purchasing a piece of property in downtown Cleveland with an opportunity zone fund investment. I know for a fact that, you know, I've counseled people on several of those, and those projects were, sorry, hopefully that isn't popping up. So those projects were acquired using opportunity zone funds, and those funds will stay in the project presumably for 10 years. You know, there will be a redevelopment of those projects because, as I said before, those when you buy a piece of real estate, that isn't new to you, and these were historic properties. They had to be rehabbed by using at least as much as they paid. So the one I'm thinking of off the top of my head was purchased for $1.5 million. The way that the statute's written is that that fund now has 30 months to complete a substantial rehabilitation of that piece of property. So they'll have to put in, you know, $1,500,001 towards that rehabilitation. Now I know they're going to do more than that, but that would be the requirement. And then as long as they maintain their investment in that fund and that fund maintains its investment in that property, they'll continue to defer that tax. They'll get their 15% reduction over the next 7 years, and then they'll recognize whatever gain they deferred that's left and hasn't been forgiven at the end of 2026. And then, you know, hopefully everybody is rooting for the continued growth of downtown Cleveland is going to see, you know, potentially a 2 or 3 times multiple on the sale of that project. And these guys will get, you know, a fairly large tax-free windfall. They will be doing historic tax credits, and that'll be done through a lease pass-through, as I had said on the last slide there. So that'll be the first 5, 6, 7 years will be done as the federal historic tax credit process. And then after the HTC compliance period is over, you know, it'll roll back up to the Opportunity Zone Fund, and they'll maintain their investment and hopefully 10 years from now reap a large benefit. Lauren, hopefully that was kind of what you were looking for. I'm not sure.
Okay, well, the next question, I'm not 100% sure what he's trying to get at. So, Richard,
Okay.
if you want to clarify just a little bit, but the next question is, would setting up an opportunity zone be something that is completed through the city or the state?
Okay, I think I understand what you're saying, Richard. So again, you know, because of this, the fact that you can use any entity to set this up, if you were in the state of Ohio, I would suggest that you incorporate either in a C corporation or an S corporation or a limited liability company. That would be done through the state of Ohio and the Secretary of State's office. There is no certification or designation by a city or state that is completed through the city or state office. So that's one aspect of that. If you're wondering how opportunity zones themselves were set up, these were census tracts that are designated by the U.S. Census Bureau. And the current census tracts are designated for the next 10 years, and we don't expect them to change.
All right. So then Danielle follows up with her previous question. If the best investments are those that make sense in the long run, say 10 plus years, and we're talking about areas that aren't or haven't been attractive to investors to date, how do we then evaluate the 10-year outlook?
I mean, that's a very fair question, Danielle. And, there's a lot of ways that people evaluate the economic outlooks of different areas. There's really no right answer to this. I think that if you're looking to invest in a large project, if I was looking to invest or put a client in a large project, wherever it is, I would want to see some sort of market feasibility report or study that would show that, that there are economic drivers here. And keep in mind, a lot of our, maybe not the large downtown areas like Cleveland, Cincinnati, Dayton, Columbus, a lot of the smaller areas do have, manufacturing that's been up and coming over the last year or two, and, different industrial uses that can be, invested in this. I want to make sure that, that we're not focused only on, apartments, office, whatever, that you can really do just about anything with these. But, the best ways to evaluate them are the ways that we would evaluate any other project, which is, market studies and feasibility reports.
All right. And then will there be a way for nonprofits to be able to take advantage of this funding? For instance, a nonprofit theater?
Excuse me. Yeah, I think so. I think that you could have a nonprofit theater partner with a for-profit entity and make some investments. It really depends on what the ultimate goal is of that nonprofit theater. I've seen, obviously we see a lot of that in Ohio through the historic tax credit program, both state and federal. And with this, what I think you could do is potentially have the theater restored using historic tax credits and potentially have the operations run by a for-profit entity. It really just depends on what the goals of that nonprofit are. If they intend to run it, it's not going to be a super attractive investment to a private investor because there's really not going to be much upside.
Okay. And then our next question is from Brandon, and he asks, in the case for redeveloping a building, is it true Opportunity Zone funds can only be used for acquisition, or can the Opportunity Zones funds be used for redevelopment costs as well?
So it is absolutely not true that they can only be used for acquisition. The acquisition that I was using as an example for Lauren's earlier question, only part of that Opportunity Zone fund was used for the acquisition of the property, and the rest of that fund will be used for the redevelopment and rehabilitation of the property. So the uses are pretty broad as long as you're invested into qualified property. So unlike historic tax credits, for example, where you don't get a benefit for acquisition, you can definitely use Opportunity Zone monies for that. But on top of that, you can have Opportunity Zone fund money used for redevelopment, for continued operations. It's pretty wide open right now. There's a lot of flexibility.
All right, and then actually, Frank here in our office has a question, so I'm going to hand it over to him really quick.
Hi, Dan. So a quick question. You were going through a couple of those examples, and you had one with a landlord LLC and a master tenant, and you talked about some of the pitfalls when an LLC may have owned a building before that cutoff date. So are there suggestions that you could offer to make it easier for that LLC to come into compliance, or is this something as easy as the owner saying forming a new LLC consortium with some additional investors, and selling the building to that new LLC. I'm wondering, is that really, are there easier ways to get around that stipulation?
So correct me if I'm wrong, Frank, but you're concerned about the transition rule and making sure that you don't potentially shift the ability to use all the credits in 1 year by using opportunity zones?
Well, I think so. Your example, that slide where you have the pass-through
Sure.
tax credit investment and the landlord LLC. Yeah, I guess maybe just go into if there are any other alternatives to that could work.
Yeah, I mean, it's really, so we've got two laws, like I said, that kind of conflict. We want to, for our historic tax credit projects, we want to try it the best that we can if we have projects that can qualify under the old rules that they do that, because the price for those credits will be higher because they can all be used in 1 year. If an investor has to spread it over 5 years, then the value of those credits is less, the amount of equity that the investor puts into the project is less, the amount of money that your developer has to come out of pocket with goes up. So we want to do our best to try and avoid that. But with the opportunity zones, you've got a bit of a conflict because you can't acquire a piece of property until after that transition rule period kind of goes away. So, in order, the best and easiest way that I can think of to do this, and again, I'm happy to take questions about this in a general sense. Please, to the extent that you're looking at applying this to your own projects, consult your tax and legal advisors. But if you were to create this pass-through structure, which we see a lot in normal federal historic tax credit investing, and your opportunity zone investor goes in as the tenant in a building that you already own, I still believe that you can qualify under the transition rules and get the 20% all in 1 year historic tax credit, and also invest rehab money into the project through an opportunity zone fund. And I think that's the easiest way to avoid that pitfall. I would say you wouldn't want to necessarily sell to a new group of investors, because then you potentially kill the ability to use the old rules and get your credits all in 1 year. Is that hopefully that was clear, but please continue if I'm missing the point there, Frank.
Yeah, I think so in that case. But let's say there's a case where you've owned a building for 5 years, but you haven't made expenditures, or you haven't started that tax credit process yet. And so let's say you're in the new rules regardless.
Okay. Well, in that case,
so in that case,
you can do either a direct or a pass-through investment. So here, I'll flip back to the direct thing there. In that case, the project LLC, your sponsor, your developer would own 1%, and your tax credit investor would own the rest. And you would just invest that tax credit investor's equity through an opportunity zone fund. And so that would be, if you're not worried about the transition rule, it's a much easier structure.
He didn't hear you.
Thanks.
Okay,
no problem.
so I think we have one more question from Danielle. She says, have you read Bruce Katz's article about investing in zones rather than individual projects? He talks about anchor districts, industrial districts, residential districts, investing in places more than single products. He makes some fairly exciting points, but I'm not sure how what we've heard today transfers to the zone approach. Can you speak to that at all?
Sure. Let me try and unpack that a little bit. I may have read that article. I'm not sure. I know I've read some that go in that direction. I don't think that there's anything that says you couldn't do that. I think that because the zones are set and because the funds are going to be self-certifying, you know, if there is an opportunity in your city, your town, your business district, however you want to break it up, to put together a fund that's aimed at, you know, generally collecting money and investing into that area, yeah, I think that that's a wonderful idea if you can do it. You know, because of the timing rules and because you have this 180-day period that you have to take your gain and invest it into a fund. And we didn't really get into the fund timing mechanisms because we don't really have that much time today, but the fund itself doesn't have forever to invest in projects, so it can't really hold a lot of cash. So I think because of some of those timing issues, I think what we're, you know, this is just my opinion, but I think we're going to see more targeted funds that are more specific to projects or more specific to investors. But, you know, there's certainly nothing that says you couldn't do that. I think that keeping it up and making sure that everybody qualifies would be a challenge, though. But, you know, happy to talk about it offline if you'd like, Daniel. I'll even go and throw up my contact info there.
She's quite the overachiever, so I'm sure she'll be reaching out to you. I think that is all the questions we have. And with that, I'd like to thank everyone for attending today's webinar. And Dan, I'd like to thank you for presenting. It's very difficult to make tax law understandable and enjoyable, but I think you did a great job. So thank you very, very much. And you know, for our future events and future webinars, you can find them at heritageohio.org. And with that, everyone, have a great day.